Hello and welcome to the next instalment of Nucleus Insights, and today it's entitled The Future of Oil. Down there again, it's just a quick run through of the disclaimer. So just a reminder that the following presentation is general information only, and whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your professional or investment professional or financial advisor before making any decisions from anything discussed today. Just firstly, of course, my name's Tim Fuller, so I'm a certified financial advisor. I've had many years of making the complex simple for clients over a number of large institutions and also a smaller boutique. And I will welcome today, of course, David Llewellyn Smith, who started off obviously being the co-author of the co-author with Ross Garnaut of the Great Crash of 2008. He was the chief economics editor and founder of the Diplomat magazine, and now, of course, is the chief editor of the highly read and very successful Macro Business blog. Welcome to you, David.
Thank you, Tim.
And just to the right of him, we have Damien Klassen. Damien's the head of investments, of course, for Nucleus Wealth. Prior to that, he has a long and illustrious history working for Schroders with some in the mining and energy and big data sector for a large quant fund managing over 60 billion in Australian dollars. Prior to that, obviously working with Wilson HTM as head of quantitative strategy. And before that, a founding partner and head of investment research for a analyst company known as Aegis. Welcome to you, Damien.
Hi, Tim.
Thank you. Okay, so agenda today, we're going to be running through a couple of things on our theme of the future of oil. We'll start off with some interesting curves there, running through commodity versus technology curves. We'll talk about, of course, some alternatives to oil and pricing there within in regards to batteries and also the portability premium. And then finally, of course, how all this ties down to investments and what we do every day, Nucleus Wealth and the Macro Business Fund. So with no further ado, let's jump into it. So commodity curves. What can you tell us about commodity curves, Damien?
Thanks, Tim. Yeah, look, this is an extension of what we did last week. Last week we had a look at the whole of energy, and the first couple of slides here I've just repeated for anyone who missed that one. But the idea is that in terms of is that oil is just another form of energy, and so there are some special characteristics about oil, but we do need to recognise that oil sits amongst everything else, and its price will be determined by the relative cost of other technologies. So we ran through the first chart we've got showing is just showing an increase in strip ratios for coal. This is just picked Queensland in particular as a big exporter. Basically increasing by about 50%. So that's the amount of dirt you need to move to get to a ton of coal, and that's over the last sort of 20, 30 years. And you find that pretty much around the world, wherever you look, that's that same type of thing. You have to dig deeper. You have to try harder to get these assets, and the same effects in oil, but they're all on a scarcity curve. The more you want, the harder you need to work to get it.
Okay,
and that's in contrast with the technology curve. So I've got an example here of just the price of the cells that go into solar panels, and sort of coming down dramatically over time. So basically got, on one hand, a scarcity curve, prices rising, and on the other, a technology curve where the more we do of it, the cheaper it gets, and the productive you get production benefits of doing a million things rather than 100,000 or 100,000 rather than 10,000.
Okay, fantastic. So I guess ultimately these curves are going to meet at some point. Let's run through that.
Yep, and so this is where we're sort of showing, our views on solar being an upper bound, solar plus battery, more importantly, being an upper bound on these technologies. So you might skip. So that's just one sort of showing solar, and then the next one shows solar plus batteries, and just the costs coming down over time and gradually meeting and going under the cost of these traditional technologies. Okay, so that's. So that was what we covered off on last week. And now the question is, how does oil fit into that? And so that's where we start with this, the idea that oil is just another form of energy, and that the thing with oil, though, is it's got what I call portability premium. It's much more convenient to stick oil in your car or petrol in your car than what it is to stick coal in your car.
Okay.
And so and so you've had this thing that oil trades at sort of $30 to $40 more expensive on a per unit of energy, $30, $40 per barrel on a per unit of energy. So because it is so convenient, you can stick it in planes, you can stick it in ships. It's a very convenient form of energy. Having said that, though, we've now got batteries approaching. So batteries we spoke about last week is sort of attacking this idea that if you've got solar power and you can have batteries that allow you to shift the time, then that affects the cost curves. This is a different form. This is basically saying batteries can also take away the portability premium of oil, and that's arguably that's already happened in generators. So it used to be that a lot of people, and it still is, a lot of people have backup generators that run off oil. They're quite expensive on a per unit, and so you're finding now that batteries are actually actively competing with that as a source. So if you've got a backup, if somebody's running a backup for a building, and they're thinking about, do I put in a generator and store some oil on site, and then if the power goes off, we can run it off that, or do I stick in a panel of batteries? You now reach the point where it's competitive and you have to make an active decision. Whereas 20 years ago there was no comparison, and with the rate batteries are coming down, we expect that to continue.
And then on top of that, I guess you've got the ongoing side of say maintenance with generators and being able to rely on them, and whereas a battery can sort of essentially sit there as long as it's not being cycled too hard.
Yeah, usually less moving parts is a huge benefit for batteries more generally. Yeah.
Okay, great.
Okay, so that sort of gives you a curve then, and what we've I've got another slide sort of showing now that the cost of these curves, and one is coming back to the driving part. So driving is obviously the biggest use of oil, and so your key question for driving is saying, well, how big is this premium, and when does that curve meet? Now the biggest factor is how many kilometers you're going to do, because if you're only doing 15,000 kilometers a year, which is sort of the typical car, somewhere between 10 and 20, then you've got this big cost of a battery, and you have to spread that cost of the battery out over how many kilometers you're doing. And the problem with only driving 15,000 kilometers is you just don't have very many kilometers to spread it out. But if you're driving sort of 100,000 kilometers per year, so let's say it's a taxi or some sort of commercial vehicle, then all of a sudden the economics gets a lot better. And you can see on this graph, basically the lines met in 2012, 2013. Now that was largely a product of higher oil prices. So when oil prices are $100, all of a sudden that popped in. Oil prices have fallen precipitously, and so have battery costs. And so we've basically been level pegging for the last little while. So we've sort of hit that point where the cost of petrol and for a commercial vehicle or a taxi, we're basically very, very close to a break-even point now.
So I guess obviously, with particularly the 100K cost curve meeting petrol there, obviously that's, essentially that's the green light, isn't it, for people to go ahead and do you see now, go ahead, in building, EVs and trucks and these sort of, and taxis, as you say, to meet that 100,000 a year. So do you think it's just taken 5 years for it to sort of come of age, essentially, for the technology or for the reliability, perhaps, of say, electric cars or electric taxis to meet the market?
It's the big thing for me is there's a perception, I guess, in terms of and it is a strange perception in a way that if that you sort of think of, well, there's a range anxiety. I want to make sure that I can actually fill up, and because you don't have very many options and it does take a long time, and I think those are gradually being addressed by the electric car industry. It's also interesting that if you had approached it from the other direction, so if everyone drove electric cars and then the price of petrol came down and all of a sudden these petrol powered cars were in, there'd actually be a lot more. I would have think there'd be a lot more fear the other way of, like, just a minute, I want to have a controlled explosion in the middle of my car, burning this energy, and if something hits it, the whole thing could go up in smoke. Or do I run on a battery? There'd be a lot more fears the other way. But because we're used to running, these cars with basically controlled explosions,
sitting on
propelling
60 litres of propellant. Yep.
Yeah, that's right. That we're used to it, and we're worried about the other thing, which is that the batteries won't last as long and things like that. So there is work to do, but I guess what I'm saying is until you get to the stage where the costs meet, it's more for the enthusiasts or the particularly green people. Whereas on the longer term, if you're doing more kilometers now, it's hit the point where it makes sense financially, or it's at least at parity. And so that's where I really think the take up starts to come.
Okay, sure. So if we jump across to the battery pack pricing, what have you got to tell us there?
Yeah, so that's just a quick update, just sort of show that battery pack. That's part of the reason why. So we've seen oil prices come down from $100, but the battery pack prices come down from sort of over $1,000 to sort of around about $200 for those costs.
Okay.
So if you're just putting it in terms of numbers, in terms of raw energy that comes out. So if you're talking about $50 per barrel of oil, that's basically about 8.6 MMBTU, which is sort of like it's a more standardized version, and it's what gas usually gets priced in. And then sort of looking at coal, so $75 coal is about 2.8. So about a third of it price is roughly where we're talking coal. So coal versus oil. So there's certainly that portability premium is very much there in terms of the oil price, and that's where the question is, how fast can batteries shrink that portability premium?
Okay.
And that's what a lot of this is all coming about.
Okay, sure. So if we've got the costs of oil and coal there, let's have a look at the other side of the equation.
Yeah. So now we say, okay, well, if I'm going to buy a car and it's got 60 watts, which gives you about sort of 400 or 500 kilometers, which is probably
60 kilowatts.
Sorry, 60 kilowatts.
Yep,
yes.
Sure.
Which is probably about the range where people are comfortable to drive, and from if you're taxi doing 100,000 k a year, filling up once a day type stuff is perfectly acceptable.
Yep.
So you're talking about $10,000 at the moment. If you're going to just comparing electricity and petrol costs, so it depends on where you are. Different countries have different regimes and different taxes, but you're basically talking about somewhere between 150 and 350 per 10,000 kilometers. So putting that back in savings.
Yeah,
so basically, if I fill my car up from straight from the electricity grid,
yep,
versus sticking petrol in it, I'm probably going to save and it's not a big amount when it comes down to it. If you're saving say $200 to $250, but it's costing you $10,500 to get there, it doesn't make sense if that's all you're driving. If you're only driving 10,000 kilometers. If you're driving the 100,000 kilometers, though, now you're talking somewhere between $1,000 and $5,000 in cost savings, and now it starts to add up. So, especially at the upper end, where you might be in countries that have got high taxes on petrol, and so it's a 2-year payback basically to get your cost of your battery comes back within that time frame.
Okay, sure. And so I guess breaking that down now. Or looking forward rather, and factoring in some cost reductions as we see these graphs are falling.
Yeah. So what I wanted to do is also talk on. So we had those costs. So the thing about batteries is they've been coming down about 20% per annum in terms of the costs. So if that continues, and we have Tesla building gigafactories, and right throughout China, there's there's BYD, which is another big car manufacturer, all building these great big battery things to bring down the cost of batteries. So if we see that continue for another 5 years, then that brings the battery cost down to $3,500.
Wow! So
at $3,500, all of a sudden, your payback in some high cost countries is basically 1 year's performance. And even if you're talking, a car which somebody might be driving 20,000 kilometers per year, okay, $3,500, you're actually starting to get into the ballpark of saying, well, I've got a 5-year payback. Maybe that's worth doing in terms of driving a personal car.
That's a no-brainer, really, isn't it? You think?
Yeah, and that's without any subsidies. So this is all. I sort of treat subsidies as being subsidies might help accelerate some of these, but you won't be able to run. You can't run subsidies across the entire fleet, but you can sort of help the early adopters, and then sort of gradually pull the subsidies off over time. But you can't run these. If you can't run the numbers on the basis of no subsidies that it makes sense, then it's not going to go mainstream. But by the look of it, you can certainly see that it does.
Yep. So I guess so obviously governments have got a couple of cards to play. They can either do the subsidy sort of route and help things along, but then obviously you can go down the other path and just start banning things as well. So maybe we'll have a quick discussion of what's happening on that front.
Yeah. So I mean, there's already a bunch of countries have come out and regions have come out and said that from 2030 or from 2035, or they've picked a pick a time in the far enough distant future that the current politicians won't have to deal with it. They've said, okay, we won't be allowing any more petrol or diesel cars from that particular time. And so I've just got a list up there of some of the ones that have done it in terms of California, Germany, China, Netherlands, Norway. So there's plenty of countries that have made these commitments, and that's certainly your wild card in terms of whether things happen sooner. So we've already seen in China, just over the last couple of months, they've shut down a bunch of factories all around Beijing to get rid of the pollution. Could you find a country like that and also China's got a limit on the number of new cars that get sold within Shanghai, so that half the new cars have to be
low emissions or electric.
Lower emission,
yeah. Okay.
So could you see a stage where countries like China or somewhere like Singapore or something like that just said, well, that's it, no more petrol cars, everything else has to be electric, and certainly it's a possibility. We've already got these in a long term, but the issue is whether it happens sooner in other countries.
It seems to me the other side of it as well is that there's an infrastructure sort of play that I think. I'm just thinking of Netherlands as an example. I was over there probably 5 years ago. It's the first time I've ever seen a Tesla, and you sort of look at it, this is it's a remarkable looking car, but where do you plug it in? But then you walk down the street and there is actually parking where we can charge it up. So if you're going to buy one in Australia, you're never going to be more than half the distance away of its range away from your home, where because you wouldn't know where to fill it in. So do you think that's sort of a big thing, and do you think that's another I guess sort of what would you say, like a government incentive that needs to be sort of put in place is building infrastructure around to support the cars? Yeah,
look, absolutely. There's a lot to do, and which is why I think if you're relying on the private car to get you there and to make the changes, then you're probably talking 2030 plus. So it is a long time, and it's a gradual change, and you get the gradual phase out and things like that. So governments could push that along, but largely if you're relying on the private car market to get you there, it is going to take a while before you see this switch. Okay, sure.
So global oil consumption here. So we've got a pretty heavy transport theme and taxi theme. So
just more just highlighting that most of it is most of oil gets used by the transport sector. So you don't need very big switches at all in terms of the and David's going to run through some of the supply and some of the supply side at the moment, and you don't need much of a demand shrink in terms of oil consumption in the transport sector to make a meaningful difference to the price of oil.
So taxis are going to lead the way, hopefully.
Yeah, well, that's the part you need to come back to now. So this is where I'm talking about in terms of driverless cars. Now there are lots of issues with these, but I just want to talk. We'll move on to some of the issues later, but I just want to talk the big picture numbers that you can look at. So if you're talking about a driverless taxi that you can call up on your smartphone, and basically it's an Uber without the driver, which is the main cost of the car. So I just wanted to put that into a picture of how much would that realistically cost. Now you've got four things that are going into that: your capital cost of the car, the capital cost of the driverless plus battery costs, so the software that drives the car and how much the battery costs, how many hours you're going to operate per day, and how many trips you're going to do per hour. So the capital cost, I'm just going to use really rough figures here just to put it, because I think the numbers come out so small you don't need to be too over the top with what you're guessing.
Yep.
But so a car company is happy to rent a car to people for $60 a day, and a pretty new car.
Yep.
So that's just your typical car at the moment. They get about a 75% utilization rate. So you're basically talking $45 a day is what a car company like a Hertz or Budget or one of those car companies is happy to rent a car for. So let's call that the capital cost of the car, which gets a return for the owner and
Covers the costs.
It covers costs.
Yep.
So we're back to $45 a day. Let's add another 15 back onto that. So let's add 30 something percent to bring us up to $60. So back to $60. So
what does that do?
That's you covering your cost of your driverless and your battery cost.
Okay.
So back at $60 per day. Now you are driverless, so you can go 24 hours a day, but there's not a huge demand in the middle of the night, so there's probably a limited number of cars. You want to charge a battery and there's a bit of cleaning and all that type of stuff. So let's just call it 15 hours.
Okay.
So you're basically saying you need to make $4 per hour to make a return. Roughly the average for taxis and things like that is about 1.5 trips an hour. So you want to add in a little bit of electricity, add a little bit to the booking company, 10% to the booking company,
yep,
and all that type of stuff. But you're basically talking about $3 a trip.
Wow. Yep.
So
and that's today.
Yeah. Yeah. And so that type of and very much contingent upon the driverless software and all that type of stuff. But we're basically talking public transport costs for a private taxi.
Yeah, private vehicle solution.
Yeah.
Yeah, okay.
And,
fantastic.
And so if you get to that level, my contention is at those prices, you get a mass market lift up in terms of, if I can get people switched relatively quickly to Uber to save themselves,
half price.
Yeah. Well, initially half price, and then it probably came back to
come up a bit now.
Maybe it's only a 20 or 30% saving now.
Yep.
But, if you could halve that cost again, the question is, will there be a widespread? And I think, depending upon getting over a few of these legal hurdles and stuff like that. But yeah, I think there's a market for that very much.
Plus, you'd get 5 people in the car as well, which would be handy on the Friday nights when you're going out to out and about. So yeah, very good.
Yeah, absolutely. The ability for people to go and not have to have a designated drivers and all that type of stuff is great. So the question is, what's stopping you from getting to this? And I sort of think there's sort of 3 different big picture ones. There are some software issues, obviously, but they are getting very, very close. So already we have Waymo, which is the Google version. They've got a trial in Phoenix at the moment, where the driver they initially had trials where they had an engineer sitting there behind the wheel at all times. Now they've put the engineer in the back seat. Mm-hmm. So they're getting very close. We do have an ethics issue. So these cars are smart enough now and they can think in real time. If I'm driving and there's a truck on one side of me and a motorbike or a push bike on the other side, and something comes out in front of me, I swerve and I take out the push bike driver. It's sort of, there's a view that, well, you did what you could, and yes, it was sad that somebody got hurt and all that type of stuff. Whereas the car actually has enough time and the programming to actually evaluate the concern and say, well, if I swerve into the truck, then I'll probably kill the occupant. If I swerve into the bike rider, I'm probably going to kill the bike rider. Which do I do? And so that's there's some ethics issues that need to be overcome.
Yep.
There's a liability issue in terms of yes, people will want to sue these car companies and things like that, but the governments will then need to balance. That will need to be balanced against governments about how many people are currently getting killed by existing drivers versus reaching a point where they can go, well, we think we could halve the death rate. Okay, there's a liability issue, but legislation needs to come in to cover that.
Yeah, and that's quite a big thing, though, isn't it? Because I think ultimately, for driver error, sort of, the driver error component of, say, the national road toll, there's a pretty strong card to play there that, that could be largely removed by literally handing the keys over to a computer to do that. Obviously, there's a lot of other, factors in the play in the road toll. But there would be a significant component that would, largely be eradicated if we went down that path.
Yeah, and I think most people as well, there's even the people who are vehemently against it. It's often they're against it because I'm a better driver than the car and I can control or whatever. But then if you sort of say, well, here's this young 18-year-old who's just got his license and is out with a bunch of his mates, would you prefer him behind the wheel, or would you prefer a driverless car to be taking him and his mates back and forth to the pub?
Absolutely.
And there's obviously an argument there that a lot of people would, yes, I'd absolutely prefer that guy's not driving around and and there's obviously a lot of there's been a few terrorist attacks recently, there's possibly a card to play in terms of that. If you've got driverless cars that can't be programmed to run into groups of people, there's there's issues with that. And I've put up there fear versus greed. In the end, it comes down to why would I get in a car that is? I like to. My analogy is that it's similar, fear versus greed, to the to what we saw in the Uber. The fear was, why would I get in a car with a complete stranger? Versus the greed factor of, well, I could save 20 or 30%. And once people got used to the fact of, well, they were tracked and all that type of stuff, the greed overcame the fear. And I think there is a similar one with driverless cars. Why would I get in a driverless car? To the fact, you start hearing about the stories. Yeah, it was fine. This happened, that happened. Someone pulled out and it stopped, and all that type of stuff. Versus the greed of, I could halve my travel costs.
Well, absolutely. And if you're using private transport like taxis and Ubers a lot, it's a no-brainer, isn't it? I guess at the end of the day. So yeah, very good. Okay.
And so on the liability side, my take is, what you'll probably find, that the real push for this is you probably will find a country like, maybe it's somewhere in China, or maybe it's a country like Singapore with quite authoritarian and quite a small country, that's where there's limits on the city and things like that. And if you find they say, well, we're putting driverless in, and from certain dates people won't be allowed to, then that could be a real sort of push. So to really show whether this works or not. And my bet is that if you got a country like that, whether it's China or Singapore or somewhere like that sort of went early, that you'd find a competitive juices in the US would then begin to flow, and there'd be a lot of places in there that would be very keen to roll it out as quickly as possible to show that America's at the forefront of technology.
The dominant force. Yeah, sure.
Yeah, and so it's hard to say when the timing is, but it seems to be relatively imminent, and it could, the next 5 years could easily be the time frame. There's things that could push it further out, but the long-term outlook for oil, based on these is a little bit concerning.
Sure, and so yeah, thanks for that, Damien. And while we are on the topic of the long-term outlook for oil, we've obviously gone into significant depth on the demand side and where ultimately, I guess, energy use is going, in particular with with personal transportation. But we'll have a quick chat to David as well to run us through the supply side of oil, which obviously is a pretty core theme of the blog. If you'd like to kick us off, David, where do you see oil going?
Thanks very much, Tim and Damien. Well, we'll start just there with the chart on the right-hand side of the screen. Is it
on the screen?
On the screen. It's this one. I need this one.
Oh, beg your pardon. There we go.
Which captures as best I can, the manifold variables that operate on the supply side of the global oil market. Rather than give you 1,000,001 charts on those, this is my consolidated version, which basically gives you the oil market balance. That includes OPEC and all of its recent push with Russia to withdraw supply, roughly 2 million barrels per day, and it includes the rebound that has come out of supply in some of those OPEC nations that were offline for quite a while, Libya, Nigeria. It also absorbs US shale and the boom in Canadian oil sands, etc. And so this one chart boils all of that down to a cyclical take on where oil supply is at any given moment. So you can see over the last few years, there have basically been three periods. The first one where we had relative kind of supply parity, leading up to the GFC, when the oil price started to climb from millennial lows, just a relatively balanced market. Then we then crashed to sort of supply shortage going into the GFC, or through sort of 2007-8, which drove the oil price very high and helped generate some of the global inflation that enabled central banks to tighten and what eventually blew up the big housing bubble that was rolling along at the time. And then we go into the post-GFC period where that supply shortage rebounded, but only briefly, as the real revolution in oil got underway, which was unconventional supplies taking off in the US. And that is shale oil, of course. And you can see how through sort of 2014 and 15, US shale just completely rebalanced the global oil market from supply shortage to very large glut, and it crashed the price coming into the end of 2015. We got as low as $28 from the pre-GFC highs of 150, so it was a considerable drop. OPEC then acted, of course, and the price as well. Sorry, it was the other way around. The price drop short-circuited the US shale boom, and that is kind of the clue to the second chart and the major kind of shift in oil market dynamics that's happened globally, really, for the first time in many decades, and that is that US shale can be produced very flexibly, very swiftly, and at relatively low capex costs. Whereas the tradition of oil is that it's very long view and very high and very capital intensive. That is, you spend many billions of dollars on an outlook for oil, that might be 30, even 40 years into the future. With US shale, you can roll out your rigs and be generating a return literally within weeks. So,
Sorry, Dave. So obviously, that obviously lends itself to the fact that shale's quite, the flexibility gives it the ability to rebound. But then obviously, is that reflected in the price of obtaining the shale? Can it have its cake and eat it too?
Well, what it's meant is that because it can come and go so quickly, it's made at the marginal price setter in the global market, and it is a considerable volume. I mean, the US in a few more years could very well be the largest oil producer in the world. The second chart I've got there is the shale break-even costs, which is what's transpired over the last 5 or 6 years as shale innovation took off. And as you can see, as innovation developed, the price fell very fast, and then we had the price crash, which crushed a lot of their input costs again, and to reach a point now where all-in break-evens for shale producers in the US are around $40. Some well below, some above, but with supply where it is today, $40, will generate considerable supply. So what that means is, when you look at my first chart there, we have sort of roughly second chart, 1.5 million barrels of growth per year currently in the global economy. And a lot of that can be absorbed by US shale when it needs to be very quickly. There's a lag between the price and the rig response of roughly 3 months.
Wow.
And so you basically now therefore can't get these large oil price spikes that we've been having through these supply shortage periods where, we were very much afraid of peak oil. In fact, the whole notion of peak oil has now completely turned on its head, and it's gone from an issue of supply side to one of consumption, as Damien's describing, where you're going to get peak oil in consumption long before you actually run out of the stuff.
Right. Yep.
So the main takeaway is that from the supply side is that unless there are major geopolitical shocks that cause considerable amounts of oil to be removed from the market, which is always possible with oil, obviously, considerable volumes are located in volatile regions, and that can always happen. But that's you can't really do a base case on that. But unless you get that kind of shock, the price of oil isn't going to go into big spikes. OPEC has put a floor under it and probably can persist in doing so, but it can't allow the price to go much higher either because it's just handing market share to the US shalers.
So the shale, as soon as they try and do what cartels do and drive the price up, the shale guys just drive it back down again.
In effect, OPEC is broken.
Yeah, okay.
They can put a floor on it, but they can't drive it up any longer. There are moves afoot in the US to try and consolidate some of the shale players. OPEC talks to them. You know, some investors have tried to kind of shift the volume-based mentality of the shalers, try and get them to control supply a bit. But it's just a very fragmented sector. It competes very aggressively. You know, it's got that real kind of
open market feel about it.
Open market,
Wild West
American capitalism thing going on, and so that they're just not succeeding. So I mean, this is just an enormous shift in the structure of the global oil market, and then you know the IEA has this running out to sort of 2040 before it peaks, and that's well after. Damien's consumption shock is going to transpire,
and so I guess that's essentially it. So the peak oil problems of the past are going to dovetail now into the demand side coming, being serviced from other energy sources.
That's right.
Yeah. Okay. Fantastic. All right. Thanks for that, David. Any final notes, or we'll move on to the investment themes?
Oh no, let's move on. That's good.
Okay. So obviously the reason why we're here. Obviously, plenty to talk about when it comes to energy and the subsets of that. Damien, do you want to just run us through some of the, the investment themes that we think about every day at Nucleus Wealth in regards to energy?
Yeah. So, I mean, following those themes, if you're taking sort of long-term views and on where the growth is coming from but also with an eye to valuations at the moment. So you do have these electric car manufacturers, and primarily Tesla, I think, is the one that hits everyone first. But there are some listed in China as well. Generally speaking, these are very expensive. There are a lot of question marks over the amount of capital they need to put in. I'm always nervous about technology stories where you do need to raise lots of capital, and even when you are successful, so if they doubled their orders, well, they need to double their factories, and so there's lots of issues with that. Whereas technology stories like Facebook's and things like that, where they double the users, they stick another couple of servers on, and they're all sorted. The profits flow straight to the bottom line. Whereas complex manufacturing problems and things like that, the complexity grows with size, and so so I'm not as enamored of those, especially at expensive prices.
Mm-hmm.
I think also there is the scope that the existing car companies are waking up to or have woken up to the fact that
they're tooling up now, aren't they? The Nissan Leaf's just been released. I know all the new versions. I was reading a review about that, and it seems like it's doing quite well. BMW i3 is quite well regarded.
Yeah, so. And plenty of them are talking about they'll be all electric by.
Volvo, yeah, Volvo trucks.
It's all going to be going all electric. There's plenty of talk in terms of what they're in terms of competitive response. So if you pick the right electric car manufacturer that manages to do well, but they're all priced for success already. So they're going to have to be super successes to make something of it, and don't discount how hard creating these cars are and how much needs to go in it. On the ride sharing side, it's a similar story. Well, first, very hard to get a lot of these are privately owned still, but again, the valuations you pay for these ride sharing, and the question coming down to saying there's two parts to it, I suppose. One is will they be able to lock others out, and have if you're charging, and what margin will you need to charge to able to lock everyone else out? If it's as simple as switching an app on the phone, and I go from paying 20% to paying 5%, in a markup, then how big is your competitive advantage, and how much do you need to squeeze it?
And I guess essentially with things like ride sharing, it's less about the car technology and more about just the web technology and the marketing. It really isn't it?
That's how many are available.
Yeah,
I think most people as well. We know already with cabs that most people don't really care which cab company they call, as long as there's one nearby that's available soon.
Price well. It might also be, in the future, I guess, where you say you go out and you buy yourself a driverless cab, for example, and then it's really just picking which ride-sharing company you're planning on using that day.
Absolutely. And the other question for the ride-sharing companies is, will they need huge amounts of capital will they need to own the cars themselves? And so do they need to raise lots of capital? So they'll get the growth, but they'll need to raise all this money to get the growth, and there's lots of questions over that business model.
Okay.
And so again, they're already priced as if they're going to be huge successes. Is making sure that you're getting them at a number that is that is reasonable. On the semiconductors and the storage. So by storage, I mean storage of hard disk storage.
Oh, right. Okay.
So in terms of both those, these electric cars are going to need a lot more componentry within them, and they need a lot more in terms of video and storing that video to make sure that if accidents do happen and things that do happen, that they're all properly recorded, and not only recording the video but the radar and all these other things that are going on at the time. So I think there's a scope within there. There's some interesting, there's a lot of things in that space that aren't particularly expensive, and as every car company goes through the process of needing to retool and revisit what goes into the cars, that's where we're finding some interesting plays within that. The other one I haven't put on that list, but some luxury goods is a bit of a left field discussion. Is so if I can't impress people with how expensive my car is because we're all in driverless cars, then I'll need some other way to impress everyone as to how rich I am. And so, so David's talking about wearing a tiara, but what else what other luxury goods do we start throwing money at in order that we can show everyone else around us that how well off we are? So so luxury goods is an area that's interesting in terms of those. And then finally, the oil companies, where I think picking the losers is an easy one. I'm happy to buy oil companies if I can see prices that are low. If they're pricing oil of $15 and $20 and things like that. But if you're pricing oil, and most car companies most oil companies are pricing oil of sort of $70 to $80 at the moment, which is a considerable increase on where we are. It's gradually coming down, but it's pretty hard to find too many other stories out there where the short term really doesn't look that good, and it's propped up, as David said, by one of the big suppliers saying, well, I'm going to hold off putting supply into the market because I don't want to crash the price. So if that's the best thing going for you in the short term, is one of your major suppliers is holding back to keep the price up, and the long term doesn't look particularly strong because you've got technological issues, then you're really relying on this amazing middle term to where people won't invest now, but they're and so the oil price will spike in another few years. But that's for me, that's too.
It's a bit tenuous at best.
Too hard to see the upside in terms of that. So so oils is certainly one area where we're actively avoiding it in our portfolios.
Okay, sure. Fantastic. Anything to add there, David? I can see you reaching for the headphones.
My main addition to that is simply that the LNG market in Australia is benchmarked to oil, and so if you have a gloomy outlook for the price, then it's difficult to see much upside for Australian LNG either. Mm-hmm. So it's probably another sector to avoid. There are probably exceptions within that. We don't buy them because they're sort of low quality companies, but the nature of the LNG sector in Australia, or at least in the East Coast, is such that there are a couple of companies in there that through exports have managed to tighten the local market and have created monopoly conditions for themselves. So even though the oil price itself will weigh on them heavily and probably trigger further write-downs on the debt that funded the construction of the LNG terminals, a company like Origin Energy, is a vertically integrated retailer of energy as well. And so it's gouging the local market mercilessly. And so you know, you could make an investment case for it as an oil company play.
Okay.
Based on that monopoly power, but as I say, we wouldn't touch it given it's not a high quality company on a number of metrics. But there are other risks to that, and that is, you know, we have another election coming up in 2019, most likely, at which point, you know, that local gouge may well be politicised again, and, you know, further domestic reservation be brought in and some of that pricing power removed. So, you know, I would therefore say, even though some of these companies are running quite hard at the moment on their short-term pricing power, Santos and Origin in particular, I'd be cautious going out even in the medium term, a year or two, given those political risks.
Okay. All right. Fantastic. Good thoughts there. So look, thanks both gents. What we'll do now is just quickly zoom into some questions and answers. I've got one here that was sent through. It's probably a question for both of you, but I'll direct it to Damien to begin with. It revolves around old world energy. So I'll give you some examples of the Royal Dutch Shell, BP, Chevron, known as, you know, the big fossil fuel sort of generators. Obviously, you know, in the work that we do every day here, there's you know, there is going to be a shift to the new world order. Do you see the old guard changing its spots, so to speak, or do you think they're just going to, you know, they vis-a-vis then be something that we can invest in? And, you know, is that available in, I guess, you know, will that come of age for us in the work that you do and the research that you do on the stocks?
Look, I mean, I'm more interested in some of those ones than I am the pure explorers, simply because they do have significant refining, and I do think that, you know, oil, despite the issues, you know, will be needed will be used in the economy for decades to come still. So there is still scope for refining. A lot of the chemical uses, it's hard to see, you know, plastics and things like that. It's hard to see that being replaced anytime soon. So, you know, there is still scope for those. My main complaint is mainly upon the price of oil, and, you know, those things that if the price of oil's, you know, $10 or $15 and you can get most of your oil supply from the very low cost places, then you know, some of those will have quite attractive uses. So, so I'm more interested in those. I mean, a lot of them, when you look at their websites of these guys, you do get a lot of pictures of pristine coastline and penguins and some.
Is that just greenwashing, do you think, or?
Absolutely, absolutely. When you come back to how much money they talk about their green energy and how much they put into, and they do talk some big numbers when they mention it. But what they don't do is put that in perspective to the rest of their profits.
Sure.
You know, yes, they might be investing 100 million here or 200 million there, and it sounds like a big number. But when your balance sheet's 10, 20, 50, 100 billion, you know, it's a drop in the.
There's a lot of oil infrastructure sitting, belching smoke in the background to behind this facade.
Yeah, absolutely, absolutely.
Okay, very good. Thanks, Damien. Anything to add on that note, David, in regards to the old world order learning and changing?
Probably I'd go back to gas. The leader on this front's been Shell, where it's snapped up a lot of global gas assets, really as its transitional play away from oil. And in one sense, you know, that might have an investment case anyway, because despite the price of oil being low and a lot of LNG being benchmarked to oil, there's also a structural transformation in the way LNG is priced, slowly but surely unfolding around the world, and especially in Asia, where the glut of LNG that's resulted in part from Australian investment but from around the world means that spot prices have been trading well under the oil benchmark, and so more and more deals are being forced by customers into the spot market. And so, in effect, the gas market is dislocating from the oil price. So someone like Shell, who has exposure to that gas, once the glut clears up, might benefit more than others. But again, it's not a compelling case in the overall scheme of things, it's really just who's looking at answering your question, you know, in terms of these majors, who's doing stuff to kind of prepare for the carnage to come. Shell looks better than some.
Sure. Okay, no problems. Thanks very much. Well, look, on that note, we are running short of time, so I'll just quickly zoom through a little bit of information on Nucleus Wealth. So obviously, we run through what's called a separately managed account. We run client money in a range of model portfolios or investment portfolios. Look, using the separately managed account obviously gives us or gives you as a client fantastic transparency in what you own. But also gives you security knowing that your cash is backed by the ANZ Bank through our platform provider Linear, and all assets are held as in a custodian arrangement with JP Morgan, who is one of the biggest investment banks in the world. We do offer, actually, on that note, given today's theme, the ability to screen out things like fossil fuels and oils through 19 different ethical screens that are available, and give you the ability to have full control on a very granular basis on your own ethical beliefs and choosing how you want your money invested. So, of course, and on top of that, we have the ability to provide what we do at a much lower cost to other areas in the market, I guess, or other examples in the market. And that's because we've been able to remove multiple layers of middlemen by essentially running our investments in-house and then using the linear arrangement for the separately managed account. You've got the transparency of those accounts, and of course, because the separately managed account means you're effectively owning your own discrete portfolio of shares and other assets, you get all the tax benefits of owning those as well. So I will just quickly just run you through, or just highlight that our next presentation on Tuesday, this same bat time, same bat channel, is on Bitcoin or Bitcon, we've called it. Now, if you'd like to register interest, just shoot across to proton.nucleuswealth.com for that, and we'll just keep you updated on what's happening there, and we'll look forward to seeing you then. Just finally as well, Matthew, our communication guru, is going to be sending out, as always, a quick 3 or 4 question survey, not so much a quiz. But one of the key questions there is just looking at giving us some direction on future webinars that you'd like for us to put together, and of course giving us some feedback on how we went today. So on that note, thanks very much for your time. I hope you've enjoyed it, and we'll look forward to catching you at the next one. Cheers.